Welcome back to Portfolio, everyone. And in this video, we're going over 8 stocks you should watch this week. These companies all have some major news headlines coming out this week, which may lead to a great buying opportunity. We have some stock splits, we have some big acquisitions, and we also have some earnings reports all coming out this week. So we're going to go over 8 different companies that you should be watching that may have a nice buying moment throughout this upcoming week. So we're going to go over these 8 different companies, evaluate some key financial metrics of each company, and overall just determine if we like what's going to happen over this upcoming week and for the long term. So welcome back to the channel, everyone. I am the Gen Z investor, and every single day we talk about different stocks you can buy, overall stock market performance, we do stock market analysis, and just go over any big stock market news and headlines. So please like and subscribe, and we're going to get right into the first stock on today's list, which is Tesla. Tesla is on this list this week because they are doing their stock split this upcoming week. So their shares are going to be a 5-for-1 stock split. So we can see Tesla's share price, of course, decrease with more shares on the market. So although this doesn't change Tesla's fundamentals whatsoever, I do believe we might see a slight surge if investors who now believe the stock is cheap, although it is currently priced the same, just at a lower dollar value, it might see a little surge, and we might see large institutions and, of course, the smaller every individual investor buy into the company right now, even though we all know that the fundamentals of Tesla have not changed. So Tesla is currently being traded around $2,200 a share, up an insane 938% over the past 12 months. 1 year ago today, Tesla shares were at $220, now up over $2,200 a share. Absolutely incredible to even think about. Market cap for the company around $417 billion, which is absolutely insane. So we had some big news coming from Tesla not too long ago from their latest earnings report. They posted their 4th consecutive quarter of profitability, so they are eligible to join the S&P 500, and we're still waiting news if they will be put into the index. So they have total revenue of $25.7 billion, and of course you can see a nice steady upward incline over the past 5 years. And if we take a look at the bottom line, as I just mentioned, they have finally become profitable over the past 12 months of 4 consecutive quarters, and that does make them eligible. You can see here in the years prior, they were losing money each and every year. So Tesla has been on this rapid surge. Their stock split is happening this week. It'll be very interesting to see what's going to happen post-split, if we're going to see a surge or a decline in share price. But of course, this is some company you always have to keep your eye out on. Stock number 2 on this week's list is another major company that is still doing another stock split. Apple, currently being traded just shy of $500 a share. They are doing a stock split as well this week, up 143% over the past 12 months, which is absolutely incredible. You can see a nice steady upward decline that has not stopped over the past few months and being traded very close to their all-time high. This was the first ever US company to reach that $2 trillion market cap, and now they're currently sitting at $2.14 trillion. So this company has seen a rapid surge in share price, but they also do pay out a nice dividend, and of course this may be a nice buying opportunity after the stock split for some investors. Once again, we all know that the stock split does not change the company's fundamentals, but it might lead to other investors who may not know that, thinking the stock is cheaper than where it once was. With regard to that dividend, they are currently yielding 0.66% with a very sustainable 25% payout ratio, and they've been growing their dividend at over 10% average over the past 5 years, and they have that 8-year dividend growth streak. With regard to their dividend safety, they have the highest possible dividend safety rating at 99, so a dividend that is considered extremely safe, very unlikely to see it reduced or suspended anytime soon. Stock number 3 on our list is another company that's been on a massive run-up, and they actually released their latest earnings report this week. That is ticker symbol ZM, Zoom Video, up 226% over the past 12 months. Absolutely ridiculous surge. And because of the pandemic and people working at home, Zoom Video's demand for their products has surged. This company has completely expanded. They're a whole different company than where they were 2 to 5 years ago. Their demand for their video conferencing platform has skyrocketed, and their share price has matched. Market cap at $83 billion for this company, which is absolutely incredible. We're going to take a quick look at their financial statements to see if they really deserve that massive market cap. So this is a company that reports their latest earnings this week. So this is one to keep an eye on because it may surge if they post positive earnings, or it may see a very fast decline if they miss what analysts are expecting. Currently being traded just under $300 a share, and we'll see how this week performs. So this is another one you want to take a look at. If we take a quick peek at their income statement, you can see here that they've done a nice job of growing revenue year over year. Over the past 4 years, you can see they've done a nice steady pickup in revenue. But in the past 12 months, they've only brought in $828 million of revenue. So they have an $83 billion market cap with only $828 million in total revenue. If we take a look at their forward PE at 227, which is absolutely incredible. That's extremely high. This company is profitable though. They brought in $50 million of net income over the past 12 months. And of course, they've been profitable for the past 3 years. So this is another company to keep an eye on because they are reporting their earnings this week. Next 3 companies that on this list are all going to make a big headline. Some will be positive, some will be negative. First ticker we have is Walmart. Walmart announced that they're trying to team up with Microsoft to acquire TikTok's US operations. And if you're unaware, TikTok is the fastest growing social media platform in the world right now. So the fact that it might be acquired by a US company such as Microsoft or Walmart, who are actually trying to team up, is absolutely incredible. And I believe it has great expansion potential for both of the businesses. And I think if a deal gets done and whoever company is awarded the deal may see a nice surge in share price. So we have 3 companies, Walmart, Microsoft, and their competitor, Oracle, who are all trying to go after TikTok, and all 3 of those companies are on the list today because I think those are very important to keep an eye on this week. They may be a nice buying opportunity because if they can acquire TikTok's US operations, I believe it really expands a lot of their profit potential over the long term, as none of these companies really have a strong social media platform within their portfolios just yet. And of course, getting your first platform to be the fastest growing platform in the world would be a great head start. So Walmart currently being traded at $140 a share, up 21% over the past 12 months. This is a company that was able to maintain operations even during the pandemic and being traded very close to their all-time high right now, which may be a red flag, but of course, if they can acquire this TikTok deal, I believe that's going to expand their business extremely fast. Current market cap at $386 billion. This is one of the largest companies in the world. If we take a look at their dividend, 1.58% dividend yield with a payout ratio of 40%. So that is very sustainable. And they are only growing the dividend at a 2% yearly average over the past 5 years. Because this is kind of a cash cow company, they are more slower growth. They are not posting fast double-digit growth year over year. This is a company that really doesn't raise their dividend very much, but their dividend is very stable. Current dividend safety score at 78, so the dividend is considered safe. Another company where it is unlikely that they will cut the dividend anytime soon, and a low beta company, so not a lot of price volatility for Walmart. And they have been paying out their dividend for 47 plus years, very close to becoming a dividend king. Next, Walmart's potential business partner, Microsoft. Of course, we all know Microsoft, one of the largest companies in the world, the second largest company on the S&P 500, just behind Apple, ticker symbol MSFT, at around $228 a share right now, up 67% over the past year, and once again, very close to their all-time high. Market cap at $1.71 trillion, another insanely large company. So overall, Microsoft is the one that was really pushing towards that TikTok acquisition, and then it was kind of new news that Walmart wanted to team up with them. So the US government stated that they want a US tech company to acquire TikTok. Walmart's original goal was to acquire them themselves and just buy the whole company just under Walmart's brand with a couple other minority owners. But the US government didn't want that because Walmart isn't really a tech company. They're a consumer brands retailer. So they wanted a US tech company to lead that acquisition. So Walmart was kind of somewhat forced into teaming up with a big, large tech firm, and that is Microsoft. So Microsoft will be in the news this week. We heard rumors that the TikTok acquisition will get done in this upcoming week. So we'll be following along to see if that has any effect on their share price. They do pay a slight dividend as well, 0.9% dividend yield, sustainable only 31.6% payout ratio. And of course, they've been growing that dividend at over 10% per year over the past 10 years. Dividend safety score, highest dividend rating, once again, 99, extremely safe dividend, very unlikely that it gets cut anytime soon. So Walmart and Microsoft, They are the two frontrunners to get a deal done, but their largest competitor with regard to TikTok's acquisition is Oracle. Ticker symbol ORCL at around $57, $58 a share right now, up slight 10% over the past 12 months, but the overall chart looks kind of flat for the past year. They have recovered from the March lows and are trading somewhere around that pre-pandemic level. Market cap at $175 billion, another large tech company, but of course nowhere near the size of Microsoft. They do pay out a dividend of 1.68%, with a very low payout ratio of only 23.8% and a 5-year dividend growth rate of over 13% average. They've only been growing the dividend for 7 years, but they've been doing it at a very fast rate. So this is the company that's trying to compete with Microsoft and Walmart to try to get a deal done with TikTok. If they can really get this deal done, overall their financial statements have been somewhat flat over the past 3 and 4 years for Oracle. They haven't really seen a really fast growth in revenue, kind of sustainable single-digit growth year over year. So it's going to be interesting to see how this will expand their company if they can get that acquisition done for TikTok. The final thing we're going to take a look at, of course, for Oracle is the dividend safety score at 99. So far, Apple, Microsoft, and Oracle all have the highest dividend safety rating. Very safe dividend, unlikely to see that cut anytime soon. Stocks number 7 and 8 on this list today. Not tech firms. These are more slow growth dividend payers. Both of these companies actually report their latest earnings this upcoming week, which is why we should keep an eye on them. Next one is Campbell Soup Company, a very boring stock. The soup that comes in those cans on the shelf, been around for a long time, a very boring company. But of course, boring is sometimes nice to have in an overall portfolio to kind of have that stability. Currently being traded at $52 a share. Nice surge of close to 27% over the past 12 months, but on the 52-week range, trading somewhat on the high side, but nowhere near that direct all-time high. And they have a forward PE of 18.16. This is a dividend-paying company, current yield at 2.63% with a 47% payout ratio. They have slowly been growing that dividend at only an average of 2.33% over the past 5 years. If we take a quick look at their dividend safety, 41, so a very low dividend safety score, barely considered borderline safe. So this isn't the type of company I would invest in if you're looking for long-term dividend income. But if you think they might be able to beat earnings expectations, show some nice profitability and actually growth in revenue during this kind of pandemic where people are hoarding on food, then this is a company you may want to take a look at. Final stock on our list today is a tech company that has actually seen a great benefit from this pandemic and this people working from home. It is Docusign, ticker symbol DOCU, currently around $215 a share, up an insane 372%. So this is a company that has grown rapidly, similar to Zoom, because of the economic shutdown, people being forced to stay at home, no more people meeting in person to always sign every single document. Docusign is like a digital payment and digital signature software that has seen a rapid growth. Current market cap at $39 billion for this company. Quick look at their income statement can show that this company has been doing a nice job. They have seen beautiful revenue growth year over year. And of course, though, they brought in $1 billion of total revenue over the past 12 months, but they have a market cap of close to $40 billion, which is absolutely incredible. So extremely high market cap once again. You can see here, forward PE, 445. An extremely high forward PE once again for this company. And of course, this company is still very young. They've been around for a couple of years, but they still aren't at their perfect potential just yet. And they are posting consecutive net losses each and every year. But if you believe we're going to be staying at home for a long period of time, and if you believe the days of signing everything in person are over, then Docusign is one company you want to take a look at. So those were 8 stocks you could watch this week. All 8 of them are making headlines. We have some earnings reports, we have some big stock splits, and we also have some big acquisition talks. So overall, all these companies are going to be making moves. We should see some price volatility over this next week. And of course, these are some companies you may want to keep an eye on. So thank you for tuning in, everyone. I'm the Gen Z Investor, and I'll see you in tomorrow's video.